All right, all right. Welcome, guys. It is Wednesday for our live. We are here to talk about housing. I've got hold on one second here. We are here to talk about housing, answering your real estate questions, whether it's buying and selling real estate or on the finance side. We have Josh Lewis here of Buywise Mortgage, my local mortgage broker. Really smart dude. Knows a lot more about finance than I ever will, and so he's here to help answer those questions, and also in the process of starting a YouTube channel. So we'll post that in the comments, but I encourage you to follow him and stay up to date on everything that he's posting as well. And Josh, how are you, man?
Not too bad. How about yourself? It's been a crazy busy start to the year here.
It definitely has. We already got some questions coming in talking about the housing market. So how about we start with a little interest rate update, keep people in the loop of what's going on with regards to rates, because that always seems to be a popular question, and then we'll start getting into some of these questions.
Absolutely. The answer is rates are still awesome. Not at the all-time lows. Started to see some headlines this week with the Freddie Mac primary mortgage market survey just saying, hey, rates off their all-time lows. There's a big fear out there. Actually, there's not really a fear out there. The media likes to put fear that, hey, we've seen the best, rates were at an all-time low, they're going to be going higher. They may trend a little bit higher. They're not going much higher. So from our best, we're maybe an eighth to a quarter off of the absolute best. Locked a bunch of loans at 2.75 today with no borrower fees, no fees to the borrower in terms of admin, processing, underwriting, or points. So obviously still really good. At our best, we were maybe doing those at 2.625, and those are for conventional loans. A lot of our buyers are using FHA financing. We also are a big part of the VA community, a couple of different online communities. So we do a lot of government lending. Those terms, because they actually have a true government guarantee, even though the default profiles are a little bit higher on those loans, the rates are lower because they have a true government guarantee to the investor. So we're looking in the 2.25 range for the best qualified. They will go to lower credit score profiles, and if you go down to the lower credit scores, they can be 2.5, 2.75. But anyway, you cut it. Rates across the board are awesome. The bigger question I keep getting from people, and we'll probably hear it tonight, is what's going to happen the rest of the year? And the short answer is the rates are going to be really good. I don't know that we're going to get much better from where we are right now, but if you said I needed a range that you would be 90% confident we stay in, I don't really see rates going under 2.5 on the 0.30-year fixed, and I don't see them going up to 3.5. So somewhere in that 2.625 to 3.25, 3.375 range for most of the year. So rates are good. If it makes sense to refinance right now, if you're a homeowner, pull the trigger, do it. I wouldn't wait for them to get better, but I also wouldn't be sitting here in fear that they're going to shoot up. And if you're a buyer, that, hey, if I wait till July, I'm going to pay 4% for my rate.
Got it. No, I'm with you on the same page. I mean, I was actually reading some stuff today, and the National Association of Realtors had put out their housing forecast price wise. And I was reading some of that, putting a video together, and in there they talk about interest rates and their expectation. Again, everybody's expectation is exactly that. It's not 100% accurate by any means, but they're thinking rates could trend as high as 3.4% by the end of the year, which falls well within that range. And I think a lot of people probably get scared a little bit when they hear, oh my God, rates are at 3.4%. But I mean, you and I have been doing this for quite some time. I've seen rates much, much higher than that. And that's still a great rate, but it also shows you that, by waiting and trying to time the market, it might not necessarily be in your best interest in some cases.
So there's a couple of things that I like to tell buyers. Say, listen, the most important thing is 6 months after we close a loan for someone, if I call them up and I ask them on the spot, what's your interest rate? They never know. So it's critical to you when you're in the process. Hey, I want to get the absolute lowest best rate. But 6 months later, you're not going to remember. You're going to know you got a good deal and it was good. So let's not stress about it too much. It's really just the big thing. And the other thing I tell people is let's not worry about interest rate. People don't generally buy because of interest rates, and they don't buy because of home prices. They buy because of the affordability in terms of their family, a percentage of their household income going to the monthly payment of a house. So while nationwide home prices are really high, all-time highs, rates are at all-time lows. So the percentage of household income going to a monthly payment has been pretty consistent over the last few years. For 2 years, so 2018, 2019, we actually had decreases in the real home prices. So home prices were going up, but when we say real home price adjusted for interest rates and adjusted for incomes, they had actually dipped and gone down. Now, last year, even though rates went down, home prices jumped a little bit, and we had a small increase to real prices. So that's the figure that I like to look at when figuring, hey, are we getting a little bubbly? Or are we getting a little too high in prices? And it's important to remember that when that monthly payment at the current interest rates makes sense for you and your family, that's when most people will make the decision to buy.
No, and I'm going to continue that chat, but I want to say thanks to Steven for the super chat, $5. Thanks, Steven. Appreciate that. That gets my kid, one of my kids a Happy Meal, so they're going to be stoked. But no, we thank you for that. So no, I'm with you, man. One of the questions that came up is, I think, a question that I get a lot, and I think it's something that you can probably relate to too, because we can talk interest rates, but Seer Guru asked, if we crash, now I'm going to eliminate the if we crash part and just go into the rest of it. It says, when is the soonest this looks to happen? If I list in April, am I safe, or should I push to list in March? So I'm going to just take the second half of the question and forget the crash part, because to me, a crash isn't really an option at this point, just because of where inventory levels are, buyer demand is. We know rates really aren't going anywhere. So the question that I'm getting a lot right now from sellers is, should I list my house now, or because the market's really good, there's not a lot of inventory, or should I wait and try to hit that spring market? Because ideally, that's really when I really want to take advantage of the market. And it's a tough question, but what I would say is that I don't think I don't think you're going to have your property value is not going to go down between March and April, in my opinion. But the advantage that you have sooner rather than later in some cases is that you might not have any competition, right? So if there's another question that came up a little bit later and asked about inventory increasing, and I'm going to address this all in the same comment, is that, normally we start to see inventory increasing about this time of the year, right? They kind of associate it with Super Bowl. The first weekend in February is when inventory starts to increase. This year is a little bit different, right? While we've seen increase in inventory, we're also seeing essentially as many properties that come on the market go into escrow. So inventory is not really increasing at all. And you have a lot of people sitting on the sidelines for one reason or another, whether they think that, that people might have COVID and they don't want them walking through their homes, or they're just trying to see what, feel the market out. Maybe they're looking to sell, or they want to sell, but they're looking at inventory and going, there's nothing out there for me. I don't want to put my house on the market and not have a place to move. And so you've got these different factors playing into the market, right? Which I think, as the pandemic starts to get a little bit more under control, vaccines continue to happen, more people feel more comfortable, I think you're going to see those inventory levels increase, because we start to get into that spring market, which is typically our best market of the year. So I think this year is not going to be any different. You're going to see inventory level pick up during that time. But what you have right now is, depending on your market here in Southern California, for example, Huntington Beach, where I'm located, there's just not a lot of property on the market. So the advantage of listing now versus waiting 2 months is that maybe you have an opportunity to have every buyer that's interested in that price point be interested in your home alone, which means that they could offer more than the asking price. It could, you could have a multiple offer situation that bids the price up maybe higher than it would normally go because of that. And you have interest rates, in the 2.75 range, as Josh mentioned a moment ago. What we don't know about April is, how much competition are you going to have? I don't think you're going to have a lot, but say there's 2 or 3 other houses in your neighborhood that now you're competing against. Maybe they're nicer than your property. Maybe they're priced better than your property. You don't know those factors, right? And so that could have an effect on, your outcome. And I'm having that conversation with clients all the time. And some people are just anxious to get it done now. And what I would say as a seller, if it's something you'd rather just take control of now, you have the control, right? As a seller, it's a seller's market, but you also have the control, which means that if you want a 45-day escrow or a 60-day escrow, or maybe the potential to rent back for 30 or 60 days, chances are a buyer is willing to do that if they can get into escrow. So just understand that, while I don't think there's going to be a big difference in now versus say 2 months from now, a bird in the hand is worth two in the bush. We've been saying that about interest rates. Why not take advantage of it now if you can versus trying to squeeze every little bit out of that market. Now, that was a long way of getting around to my point there, Josh, but go for it. What do you, anything to add to that?
No, the only thing we had, you nailed it. We look at a lot of the same numbers and the same statistics, and you covered pretty much all of it. The only thing I always like to add or ask in that question is, what are you doing? Are you moving out of the area? Are you just selling? Is it a rental property that you're selling and putting the money in your pocket? Because it can impact your decision. If you're looking at buying, you're going to sell and buy. You may sell for a little less right now than you would get in the spring or summer, but you're going to pay a little less than in the spring or summer. And going back to your point of right now with so little inventory, sellers have a ton of leverage. If you're looking to buy another property, that leverage can help you. You can, if you have 20 offers, you can say, hey, I would like to sell to you, but we're going to close when I find a property and get it under contract because I'm going to be in that same position. So really, no, nothing additional in terms of the numbers other than to say, think about where you're going, what you're doing, and what your needs are on that end. And if you're looking to buy another home, to me, it would lean more towards doing it sooner, even though you might get a higher price later on in the year.
No, absolutely. And something to keep in mind too is if you're a seller who's also a buyer, it's not as easy as just selling your house and going out and finding the next property, right? It's going to be really good on one side where, if you're priced right, chances are you're going to have a really good experience and you're going to get more money and it's going to be really good. But then when you go to look for property, depending on your price point, it might be tough. So these are things that you need to start thinking about now versus, just when I list my property, I'm going to go find that house, because I have clients personally, and Josh is doing the loan for these people. We've been in escrow for, I don't know, 2 months, trying to find them a replacement property. We've put in offers on properties we've lost out, but honestly, there's just not a lot of property out there in their price range. And so, they're struggling to find that property. And meanwhile, the buyer is still hanging on that property because guess what? They have nowhere else to go. I mean, they're pretty much committed at this point. So it's
and Jeb, talking about those buyers specifically, it's not a question that someone here asked, but most of the folks in the audience and what they're thinking of, that's instructive for them. Why don't you tell them a little bit about the offer, the counter offer that they got back that they didn't like and didn't want to go up? I remember it was a small amount, nominal amount in hindsight in terms of an increase to the price. And 6 weeks, 8 weeks later, if we gave them the opportunity, I'm pretty sure that they would go back and happily accept that seller counter offer.
Yeah, I mean, without getting into a lot of detail, I mean, they listed their property at an amount. Let's just say it's in the low 600s, and they got an offer over 700 or pretty close to 700. So they got over 10%. That's accurate. Over 10% more than they listed the property for, more than they were comfortable with initially. But yet when they went to put in an offer on another property, they went a little bit above the asking price, I believe. I'm actually having a hard time remembering exactly where they were, but they got a counter back, and it was very small percentage over where they came in. So they made 10% more on their sell, but they weren't willing to really go above and beyond when making that offer. And they would have been comfortable selling at that lower number. And so it's one of those markets that it's a little give and take on both sides. And nobody wants to pay more for a property than it's worth. I mean, sellers want the most amount of money and buyers want the best deal. I mean, it's just the reality, whether it's homes or cars or anything. I mean, that's just the how people want to buy or sell things. And so in this market, you've got to be willing in some cases to go above and beyond if it's the right property. Now, you shouldn't do that on every one. And in their case, they're saying that wasn't the one. But, now that home is increased another probably 3 or 4%, 5% in value since then. And so they would already have equity. I mean, it's crazy just because of how crazy the market's gone.
And for us as professionals, it's a fine line. You don't ever want to, it's someone else's money. I don't want to advise them, hey, it's just another $10,000. $10,000 is real money. But a couple things that I like to point out in that situation, when the market is going up 5 to 10% a year on a $700,000 house, it's going to go up $35,000 in the next year on the low end. So you may be paying it a month or two early, but you're not paying more than what it's going to be worth. You're not going to be risking being in an upside down position. And most importantly, for those well-qualified borrowers, at rates under 3%, your mortgage is costing you about $4 per thousand. So in real terms, what we were talking about with a $10,000 higher counteroffer, which ballpark what that offer was, it would have been another $40 a month. So for most people, would you rather pay $40 more a month and be a little bit early at the higher price, or would you rather miss out on it? So again, we don't want to sit here and say, hey, it's your money, let me spend it and push it higher. And at a certain degree, it becomes a self-fulfilling prophecy when every buyer is out there doing it. But there's a lot of mental energy that goes into home shopping and making offers and getting attached to a home. And there's an emotional component too, because it's going to be your home. It's not just an investment. I'm not buying a car that I'm going to drive around for 4 years and move on. So all of those things are important, and it makes it a little bit more stressful, a little bit more difficult. But we always like to quantify for someone numbers. So like when Jeb gets a counteroffer for a client we're working with, first thing I want to do is get them numbers and quantify for them. Hey, yeah, they want $5,000 more. It's $20 a month. They want $50,000 more. It's $200 a month. So they can look at that decision and go, what does it really cost me? And is that home worth it to me?
No, absolutely. And we're doing that on and I'm actually going to do a video soon where I talk about some of these counter offers that I'm getting back on buyers and what buyers should expect in this market. I mean, the one I received today was crazy. I mean, what they're asking for. And the reality is somebody's going to agree to it just because of the market that we're in. Charles, thanks for the super chat. Appreciate the $5. That's awesome. So let's go back up here and address some of these questions here. Now, Steven was the first one that gave us here. I don't know if he had a question or if he was just talking here, telling us do not overpay. And then he's talking about landlord bought his building at 400. Okay. Not really much there. So any questions you see, Josh? Let's see.
Well, yeah, we got Nicole Jansen there. Why don't we jump in and look at that one?
Okay.
I own an FHA loan, triplex, owner occupied, been there for 2 years, have 10% equity in the property, want to buy a single family residence. Can I qualify for another property with FHA or 5% down conventional as a loan down payment available? You're in a good situation on this. If you owned a single family and you were trying to buy a triplex, could be a little bit hard to get an underwriter to believe you're going to own or occupy that. But since you have the triplex, pretty easy to say, hey, this was a great property. I enjoyed living here. I want to keep it as an investment, but I'm going to look at a condo or a single family residence and move on. So all of the options that would be available to any buyer would be available to you. So FHA may not be because you already have the FHA financing. So there's restrictions on that. So it's probably not going to be FHA, but moving on conventional to another property, you absolutely could. Both Fannie Mae and Freddie Mac, if you're on standard balance loans under the 522 threshold or 540 and change threshold, you could do 3% down, but both of those require you be the first time buyer. So 5%, you're pretty much at the right answer. A conventional 5% down to buy a 1-unit property, condo or single family should work just fine for you.
And I have a question. I'm going to thank Steven again for another super chat there, man. Thank you very much. So Josh, I don't think there's a question. There's just a comment, but I have a question that I think a lot of people could be helpful with. So back in the day when you did a loan and you had a property, or maybe you didn't have a property and you were looking to buy something, it had to make sense, right? It had to make sense to your job, right? So if I worked in Huntington Beach, for example, and I wanted to buy a property in, say, Fountain Valley, which for us is 5 minutes away, that made sense to the underwriter, right? Because I work here, I live 5 minutes down the road. Now, what's to say now, because people can work remotely, they don't necessarily have to be in an office or drive to an office. And let's say my job is in Los Angeles, and I say, you know what, I want to buy a property in Phoenix, right? What's how does an underwriter looking at that now? Are they still scrutinizing it like they did 10 years ago because it's not in the same market? Or are they thinking, hey, this could be an investment property, we need to do more due diligence because of the location?
So if you're stating that something is going to be owner occupied, the commute has to be a reasonable distance. So reasonable can be in the eye of the beholder. I've had situations. I had a client a few years ago that was buying here or was working here in Santa Ana, and they bought on the far end of Victorville. And that, for those of you in other parts of the country, is a heavily trafficked commute. And it was going to be close to 2 hours each way every time he had to come in. And we were able to get that loan through, but we had to come up with a very plausible reason. He only worked 4 days a week. He had family in the area that he could stay with a day or two a week. But in Southern California, and I'm sure in many other high-priced areas, we're seeing that, where people want to own their home and they'll move farther out. What I've seen most of the time with that is that people will sell within 2 or 3 years and decide the commute wasn't worth it, or they'll get a new job closer to home. But yeah, commuting distance has to make sense. The occupancy has to make sense. If you have a sweet single family residence worth $1 million and you say you're going to move into a $600,000 fourplex in a lesser community, it's pretty hard to get an underwriter to accept that that's actually going to be an owner occupied property.
No, I get that. But what's to say that I work from home now? What if I don't have to drive into Los Angeles anymore? And
Easy.
I want to move to Arizona.
That's easy. All we need is the employer to confirm that you are no longer required. Like I have, I'm in a big veterans group on Facebook, Vetted VA, and I have a client from there. She's in the Bay Area. Prices are nuts. They're moving to Bakersfield, and she actually works for Kaiser Permanente, but she's in HR. She's permanently remote. She never has to go back to the office. So she's saying, hey, to get what I want here would be $1.5 million. I can go to Bakersfield and get better than what I want for $600,000. So yeah, that stuff like that with people who can work remotely, we just need the employer to confirm absolutely you are able to work permanent remote and you do not need to be back in the office.
No. Okay. Yeah, that makes sense. I mean, I figured you would have to get some documentation, but I mean, that's not going to keep people from still getting the documentation and doing something crazy. But coach, trainer, mentor, thanks for the super chat there. Appreciate it. I'm
hey,
seeing
Jeff,
a lot of
the coach, trainer, mentor actually asked a really good question here. So let's jump in and answer that. It was right. Earlier, we kind of skipped over it. Yep. How much are closing costs for a $700,000 home through a VA loan? I recorded a video earlier this week, hasn't been posted yet, but what do closing costs look like? Now, this is an interesting question because I can give you a very clear and certain answer for the state of California. These vary, and they vary in a couple of ways, just regionally. Some areas, title insurance is much more expensive. In some areas, for that really expensive title insurance, they handle most of the escrow elements that we have in California. So you have a very small settlement charge that title adds to that. You also have your prepaids, which prepaids include your prepaid taxes and insurance. If you're in Florida or Texas, hurricane areas, high wind areas, you can have really high insurance. You can have taxes that are due once a year. And if you're at the wrong point of the year, we have to collect a bunch of prepaid taxes. So don't know where you're at, but if we're in California.
He's in Hawthorne.
Okay, so you're in Hawthorne. So a $700,000 home with a VA loan is not going to be all that much. A range would be $4,000 to $6,000 in closing costs. And this time of year, plus or minus $4,000 to $7,000 in prepaids. So total with the VA loan, you have zero down. So you're total looking at needing about $8,000 to maybe $12,000 on the high end. Now there are a lot of lenders out there, without naming names, that charge a lot of fees, and those closing costs could be $2,000 or $3,000 higher. But with a reputable, reasonable lender in terms of closing costs,
Josh Lewis.
You're that guy. You're looking at $8,000 to $12,000 total, and we can get you those numbers dialed in. Really, the only variable piece there is when you're closing, because that will dictate the prepaids. Just how much needs to go in the impound account so that there's enough to pay your taxes and insurance when they come due. So with that, in a couple of minutes, you tell me when you're going to close, what month of the year you're going to close, and we can get you a very, very tight estimate on that.
Cool. And I also want to talk about this other question that he asked, because another good question, and we get this a lot. So, is it smart to buy in 2021 or wait until it's 2022? And I guess the question is, why would you wait, right? Are you waiting because you think that values are going to decline? Are you waiting because there's a life situation that you're trying? I mean, what is the reason for your waiting? I think if you're waiting because you're trying to time the market and you think prices will go down, I think prices will be higher this time next year. I did a video where I talked about this earlier. You know, the National Association of Realtors is saying somewhere around 5.7% as the, you know, as a whole, as the nation next year, as far as appreciation. But different markets are going to appreciate different ways. I mean, they said LA County, which I mean, not LA County, but Los Angeles, they lumped Los Angeles, Anaheim, Long Beach all into one, and showing somewhere around 7.5% in 2021. So you do the math. I mean, if you want to pay 7.5% more for a property in 2022 with the idea that, you know, you're going to wait and just see what happens, then I would say go for it. But I think what I always tell people, and this is going to stand true until the end of time, is that as long as you're not extending yourself, you're not using all the money that you have, you know, in the bank, you're comfortable with your monthly payment, and you plan on being in the property for a period of time, 5 years, set, whatever that number is, as long as you're not planning on buying this year, trying to sell it for more next year, or maybe the year after, and you're not settling on that, I think now's a good opportunity to take advantage of the market, because I do think home prices are going to continue to rise for the next couple of years. Josh, any
Yeah, I want to throw another angle in there, because you mentioned some estimates from the National Association of Realtors. Anytime we put out numbers like from any realtor group, people will say, well, realtors want values to go up, so obviously they're going to keep pumping it and say it's going to go higher and higher and higher. I was on a conference call earlier this week. The American Enterprise Institute is a think tank, not really partisan. It's not political. They're looking at just issues that are impacting the economy, and they just crunch numbers. Their take is even more extreme. They think, due to land use policies, the lack of building, the limited supply, and demographics, that we're likely to see low single-digit increases this year and low single-digit increases in 2022. And they're not saying that, you know, it's easy to dismiss realtors saying, hey, we're cheerleading the market. These guys are saying this is a bad thing. We do not want home values going up multiple years in a row at or near double digits. Homes quickly get unaffordable because incomes don't keep pace, and we don't have a lot of room for interest rates to go lower. So I think they're a little bit just scared themselves. I think they really believe those numbers. I don't see 10% happening, and I don't see it happening 2 years in a row, or it would be almost 3, because I think we ended up at somewhere around 9% for 2020. So I don't see it happening, but I don't see anyone other than crazy YouTubers wanting to throw clickbait titles up there talking about a housing market crash. It's just not coming. There are some bad things happening on government loans, FHA and VA, in terms of forbearance rates, and looking at what's likely to happen. But again, the numbers are small. The numbers of those that are likely to end up in foreclosure, that's a terrible tragedy for anyone who would lose their home. But most of them have a bunch of equity, could sell. We're not even talking about a short sale or foreclosure. And if someone just wanted to push it and say, I'm going to stay in this house until the day they boot me out, first of all, it takes quite some time to be able to do that, especially with the moratoriums in place. But most people aren't going to do that. When they determine, hey, I have a new financial situation and I can't pay, I have to sell, it could bring some additional supply into the market and moderate those increases from the 10% level down to 3 to 5%. To me, in a perfect world, if homes went up 3.5% a year every year, we would all love that. You could kind of count on it and plan. It's not the way it works. We have these periods where they're too hot, and then we get a correction, periods where they're too hot, and then we get a correction. But anyone that knows economics and actually runs numbers and looks at it, you can't give me a rational case for a housing market crash in the next 3 to 5 years with the demographics and the economic situation. So talk to me again next January or February if we see another 10% this year, and maybe I'll change my mind. But hopefully it moderates and we have something more along the lines of 5% appreciation this year.
No, and I want to talk on that in a minute, because I mean, just for a second here, because a lot of people, you know, comment on videos or even talk to me and they're like, you must be thrilled that the market's doing what it's doing right now. You must be so happy that the market's going to appreciate another 5%, or you're just making bukus of. No, I hate this. I mean, I would much rather see a slower market right now where buyers could put in offers. Maybe there's a multiple offer, maybe there's not, but where homes were selling at fair market value, not way above, because it's really, it's a difficult process right now. It's really difficult on buyers, but it's difficult on agents as well. I mean, it's not easy to coach people through what's going on right now. I mean, it's not sensible. What's happening in a lot of this stuff is it's just hard to put into a way that a buyer, especially a first-time home buyer, can understand. And everybody's looking at you for answers. And in 18 years of doing this sort of thing, this is, I mean, I've never seen anything like this move as quickly as this has. And unfortunately, I'm not seeing a big slowdown either. And you're seeing a lot of it on your side as well, Josh, with rates and loans and all that good stuff. So just know that the realtors out there that have been doing this a long time don't necessarily like this. I mean, we like a more, balanced market.
Well, Jeb, let's look at a couple of examples here. If normally a client looks at 10 homes and writes an offer on 2 or 3 before getting one accepted, in the current market, they're going to look at 25 to 30 homes and they're going to write 10 to 15 offers. That's work. You just did 3 to 4 times more work for the same payday is what you normally get. Now, let's say people go, well, it's great for listing agents. They have a listing. You told the story of the guy in Austin that got 90 offers. Have you ever tried to wade through 90 offers and determine what 90 of them look like and advise your client? You just 10x'd what your work is for that seller. So it's great. The seller's going to come out way ahead and you're going to pick a great buyer, but workloads are super high. For us on the lending side, again, every time Jeb goes out and writes an offer for that client, it's a new pre-approval package. It's another call out to the other agent. So it's exponentially more work for the same amount of pay. So no tiny violins, no one's crying for us. We chose this industry. It's a great industry. We both love what we do. But I would much more prefer a balanced market where neither sellers nor buyers have all of the leverage. Right now, when it goes either way, it's not great. It's not a lot of fun.
No, it's no different than I'm not going to even get into that. So never mind. I was going to use a political statement, but we're going to stay away from those. Let's see here. Let's pick a question and talk about it. So,
you mind if I throw this one up here, Jeb?
No,
Christian Diaz, we talked about closing costs and says,
okay,
buying a home in Antelope Valley quoted $8K in closing costs. If that is legitimately closing costs, that's excessive. It shouldn't be anywhere near that for a home in Antelope Valley. But one of the mistakes that I see buyers making just in discussing their situation with other people is saying, I went to buy a home. They told me it was going to be $8,000 in closing costs. So Christian, I'm sure it's not a VA loan, but say it's a VA loan, so there's 0 down. So the $8,000 is all you need to come in with. There's a very good chance that that's $4,000, $5,000 of closing costs, and $3,000 or $4,000 of prepaid items. The prepaid items are going to be there whatever lender you use. It's not a closing cost. It's not a function of the lender. They're prepaids, meaning it's a prepaid interest, prepaid taxes, prepaid homeowners insurance. They're costs of homeownership that you have to pay at the time of closing. So closing costs are things that you are only incurring because you're buying a home and getting a loan. Your escrow fee, your title insurance, your notary, your recording, appraisal, credit report, any junk fees that your lender wants to charge you on top of that. So again, if those are true legitimate closing costs at $8,000, unless it's the nicest home in Antelope Valley, that's absurd. But always be careful that it's not the total amount of closing costs and prepaids, because if so, it's maybe a little bit high, but it's not excessive. And it really just depends on the price. For a $250,000 house, that's excessive. For a $450,000 house, I don't know that it's all that out of line.
No, that's a common question that we get is closing cost. And people don't understand that it varies. There's so many factors that go into it. It's almost impossible just to quote closing costs it is impossible without knowing the facts. So we have another question here that I'm going to throw your way, Josh, because I think this is something that we hear often. Can you compare the following for a buyer: low interest rate and high home prices versus high interest and low home prices? Which is preferable?
So if I'm a buyer, if I'm looking at it as an investment, whether I'm buying it for my home to live in or as just a pure investment, it is an investment over time. I'm hoping to make money. I would much prefer high interest rates and low home prices because the home price is a fixed thing. It's never going to change. They can't go back and charge me more for it later. Interest rates change and they're cyclical. So we're in a 40-year bull market in bonds, meaning higher prices for bonds, lower yields, lower interest rates. So whether you're investing in treasuries or mortgage-backed securities or getting a mortgage and lower interest rates, We're now going on 40 years where they've gone directly down, and we're looking at another 10 to 15 years before anything would possibly change that. So give me the higher interest rate, because I know in 2, 3, 5, 7 years, I'm going to get a much lower interest rate, and I have fixed the low home cost of acquiring the property. So the other way around, the only way that lower interest rates and higher home prices are problematic is if that were to change. If we legitimately thought in the next 2 or 3 years the rates were going to spike to 6 or 7%, home prices would have to correct. We talked earlier that people don't choose to buy a home based off of the price of the home or where interest rates are. They look at the monthly payment. Both of those factor into that equation. And if they feel comfortable with the payment based off of what percentage of their household income goes to it, they will buy. So if rates were going to spike to 6 or 7%, home prices have to come down. They're not going to. There's another discussion for another day. A lot of long, detailed economic analysis goes into that, but we have not seen the end of low interest rates. We haven't even seen the bottom for low interest rates. They will bottom eventually, but we're not there. So if you buy today with 2.75 and the house that was $700,000 a few years ago is now $1 million, in the next 2-3 years, we're likely to see a 2% interest rate and that home be $1.2 or $1.3 million. So it's not to say that either one of them is a terrible thing, but you give me my choice, give me high interest rates and low prices.
No, that's good, but I don't think we're going to see that anytime soon. So if you're sitting on the sidelines waiting to buy, which I think that would be the main reason someone would ask that question. Maybe I'm wrong, T, but if you're thinking that you're going to wait for home prices to go down with high interest rates, I think you're going to be waiting a very, very long time. And I think it'll be one of those things where you look back and wish you had gone the other direction. So I'm going to bring up another question here from Nocturnal 32387. So will Biden's $15,000 tax credit do more harm than good for the housing market in California? And will that tax credit affect interest rates as well? So I'm going to throw this to Josh just because I've talked about it multiple times in videos, but I'm going to just start off by saying this isn't something that's even been proposed at the moment. It's not a bill. It hasn't been thrown out for anyone to vote on. This is something that he campaigned. When he was campaigning, he mentioned. So at this point, we don't 100% know that this would even be something that comes to light. But let's say that it did. Josh, what are your thoughts on doing more harm than good for the market?
So that's the important part of the question. The second part we can talk about really quickly. Will the tax credit affect interest rates? Have no impact whatsoever on it if it came to pass. So will it do more harm than good? I already had some pretty strong feelings on this. I'd shared it with Jeb, shared it with my business partner, Scott, and I'll defer back to the conference call I was on earlier this week with the American Enterprise Institute. These guys were up in arms. They're like, how in the world, other than pandering to voters, would you give $15,000 away to incentivize home buying when we already have an imbalance of buyers to sellers? We don't have enough sellers. We have too many buyers relative to the amount of sellers. We have a long history in the United States of incentivizing home ownership. There's a lot of good that comes from it. But to incentivize it when it's already sort of a mania in terms of the volume of people looking to buy homes versus the homes for sale, it's just insanity. We have low interest rates. We have low inventory. Let's give people more money and more of an incentive to go out and buy. If we also go back to, was it 2010 the last time they did this? Gave a credit?
Was it 12? Yeah, it was Obama administration. I just don't remember exactly what year it was.
I believe it was 2010. Yeah. And if you go back, and the only thing that happened,
7,000 at that time, I think.
Totally different market. You can't draw parallels to that market and this market. But what happened then, the market was slow. There weren't a lot of buyers. So the government said, hey, let's incentivize and move buyers into the market. And what happened was, for the time that incentive ran, which I believe was all of the year, it ran out, either ran out on a specific date or on December 31st. A lot of buyers went out and bought. And so we saw a little spike in home prices. Well, the next year, all the buyers that likely would have bought the next year had got pulled back into 2010. So we saw less buyers in the market, same number of sellers, and it gave back those gains. So all of the people who got the incentive, they were like, hey, this is great. I got $7,000 or $8,000 to buy a house. Their home value dropped 3% the next year, and they gave it back. Now, over time, everyone is fine. Unless you somehow magically lost your home in 2011 or 2012, they've doubled in the last 10 years. But other things being equal, it is bad when the government intervenes in markets and impacts them. That would be the case with a $15,000 tax credit. It's the case with them stepping in and artificially pushing rates even lower than what they would be right now. Most people don't know that the U.S. government has bought almost all new supply of mortgage-backed securities since COVID broke out. So the interest rates that we have, yes, rates should be low. They probably shouldn't be as low as they are right now. Wouldn't be as low as they are if it weren't for government buying, and prices would not be as high. We would still have supply-demand imbalance, but you wouldn't have the issue with, you're just throwing gas on the fire, and that's exactly what the tax credit would do.
No, and I'll add to that too. In that's not just a problem for California. You ask for California, that's a problem for anywhere that has supply demand issues. So, like Josh said, I don't see it. I don't think it's going to come to light anytime soon. Just because, yes, to answer your question, I do think it would do more harm than good. So, what other questions do we have here that are? Let's see here. See anything that's sticking out to you here, Josh?
Well, there was one again. I'm up earlier in the comments here, so some of you maybe got overlooked. Let's take a look at this. So Charles Pollen says, "What percent of the gross income is the loans?" And I believe the question there is, what percentage of your gross income can go towards your housing and debt payments to qualify for a loan? So it varies by the loan type. So let's start with the easy ones. FHA, your housing payment can be up to 47% of your gross income. And when you factor in all of your other debts, we can go as high as 57%. Now, that's not guaranteed. That's for the best qualified borrowers. If you have lower credit scores, you may not get an automated approval that high. If for any reason you need a manual underwrite and it can't get an automated approval, it's going to be lower and more in line with the typical guidelines. But 47, 57 is easy for FHA. For conventional, for the best qualified borrowers, we regularly get approvals with 50% debt to income ratios. And they really, on an automated approval, only look at the total debt to income ratio, your housing payment, all your other debts. I'm not to say that in the automated, the housing to income ratio never comes into play, but they will typically let the well-qualified borrowers go to a double ratio, and that can be as high as 50%. For lesser qualified borrowers, 45 can be a hard stop. And for really marginal borrowers, a 620, 630 credit score, and I've seen them like stop them at 40 or 38. And it is truly, automated underwriting is truly a black box. When I started in this business in 1995, underwriting guidelines were written in stone. You had a manual and a person signed off and ran the numbers and says, does it meet this? Now we have automated underwriting systems and we know what their maxes are, but when we're not allowed to go to the max, we don't always know why. The last one would be VA loans, and VA loans actually have no maximum debt to income ratio. I've never seen an automated approval on a VA loan above a 70% debt to income ratio, but Jeb and I had a client last year with a 69% debt to income ratio on a VA loan. And VA, you say, well, that's crazy. Those people are all losing their home. VA uses a different calculation. They look at your family's disposable income based off of the property you're buying, family size, all of these things. And in that situation, he passed their disposable income test and we were able to do it. So hopefully that answered that question.
No, that's good stuff. I mean, I'm shocked every time I hear the VA DTI. I'm shocked. And he still owns his home. A couple years later, so he was good.
Better yet. So again, we go back to the question of would you rather buy with low prices and high rates? His property's gone up what, $100,000, close to 25% in the 2 years he's bought it.
Probably, yeah.
Probably. So he bought when rates were relatively high. They were coming off that late 2018 peak, so early 2019. We did an IRRRL. We dropped him about a little more than 0.5%. We just closed another IRRRL for him, which is a non-income qualifying sort of streamlined VA refinance. So he's down 1.5% on his interest rate, and yet he has the fixed cost of his home. So he's loving life. So now he's down to like a 62% debt to income ratio, Jeb.
I want to pull up a comment here because Jennifer Lego has a comment, and Jennifer is one of the moderators here tonight, so she's helping me out. So thank you, Jennifer, for doing that. And she's also a member of she's one of the HomeWise wizards, Josh. But anyhow, she's asking a question here. Can you do a manual underwriting for buyers that have no debt and no score?
This is one of the questions that comes up, and I would actually have to research to tell you for certain. But can you do a manual underwrite? Yes, you can do a manual underwrite. Can you do loans for borrowers with no score? Yes, you can. Trying to combine the two would get really difficult, and the guidelines between FHA, VA, Fannie Mae, Freddie Mac, USDA all vary. So we'd have to do a little research to be able to tell you whether you could combine those. And then you also run into the fact of, can you do it per the guidelines put out by FHA, VA, Fannie, Freddie? And then is there an investor out there that will buy it and a lender that will approve it? We talk a little bit in here about overlays. Like, here's the FHA guideline, but lenders sometimes have a little overlay that's worse. Even if it met the guidelines, I would venture to say that there is not an investor out there super stoked on the idea of a manual underwrite and no credit score. And I guess I should back that away from that a little bit, because there are lenders that will do no scores, and the no scores are weird because typically there's a borrower with a score and a borrower without, so it can't get the automated approval. And you fall back to an FHA where it's much more common to have a manual underwrite, or a VA where it's much more common to have a manual underwrite. The conventional loans, technically they can be done. I just don't know of any investors or lenders actually doing and approving them.
No, it's, I mean, I remember when I did loans, that would be an absolute, like, no chance. And more so today. I mean, I guess there's options, but there are ways to build people's credit, right? I mean, but that's a whole different conversation. If people don't have a score, I mean, are you still able to get, like cell phone bills and that sort of thing to show that you have not debt, but that you made your payments on time to kind of create a score?
It's a really important thing that you said, because if you had no credit, if you couldn't do any of those things, no one is making a loan to you. All of the guidelines that say it is okay to have a borrower with no credit score, what they do say is you have to bring us some alternative credit. Show us a cell phone, show us a utility bill, even a gym membership, just crazy things that wouldn't normally be considered. If you can show a payment history on it, we want to show that you're using finances and have actually used money, even if it can be a banking account. Sometimes you want to show a history of Venmo or whatever, something showing, hey, I do have a financial history, even though it's not traditional.
No, and that's what I remember, and even those were kind of a pain to do back then. But hopefully that answered your question, Jennifer. Moonlight Sunrise is asking for your contact details. We'll throw them up here. Josh, if you want to throw them up now, you're welcome to do it. Moonlight Sunrise, if you want to reach out to me directly, you can email me. I'll provide you with that information as well. So whatever's easier, Josh, we can do. And
yeah. I just threw it up there, and Christian Diaz was asking the same question. Obviously, our purpose is here to answer questions and help people. We're not necessarily here digging around for business, but because when you tune in late or you don't know, we're not sitting here throwing it out. I can lend anywhere in the state of California. So people will always ask, well, I'm in the Bay Area. Can you connect me with a good lender? We do loans throughout the state of California. The guidelines are very consistent. Lending guidelines are the same. The processes are very similar. Northern California is a little bit different in that on a purchase, you don't get escrow instructions until you're at loan docs. Other than that, the process is exactly the same. So any of you that don't have a lender you love, or you're falling out of love with your lender, we would love to help you, but really we're just here to answer the questions. And most importantly, Jeb has said this 1,000 times, if you're in any of the other 49 states, I have a big network. Jeb now has a big network of awesome lenders that we can connect you with. I'll tell anyone that will listen, 80% of lenders are not someone that I would trust my family to. 20% are truly bad actors. 60% are somewhere in the middle. They're just mediocre or average. This is a really important transaction for you in terms of building wealth long haul. I want to be with one of those top 20%, if not one of the top 1 or 5%. So we have a nice network of those people that would love to help you if you're not in California.
There you go. And he has a YouTube channel that he started. So Buy Wise Mortgage. We'll throw that up there too in a minute. Or search for it. There you go.
There's a fancy one. There's the long URL for it.
Yeah.
So,
all right. So grab that while you can. Throw that in the comments too, Josh.
Okay.
I'm going to grab a question here. So this is one that comes up. Thoughts on forbearance ending? Turoman 616 has forbearance on an FHA loan. He's going to need payment deferral. His job changed at the beginning of the year. So thoughts on forbearance ending? So, it's a good question, and it's one of those that's really hard to figure out what's going to happen. So I look at the numbers that Black Knight puts out whenever they do their reports and understand that a lot of these reports, a lot of this data that us as agents and or mortgage professionals put out is usually a month old, because they have to gather the numbers before they can put them out, and it's usually from the previous month or what have you. So Black Knight puts out really good data on forbearance ending, and what happens is what they're showing rather is that the large majority of people exiting forbearance are actually making their payments on time. Now, a percentage of those people who have exited forbearance have asked for an extension or gone back into forbearance. Now, a percentage of those people who they're saying paid on time also either refinanced and got out, and paid off the forbearance and or sold their property. So it's not like they all ended and just started making their payments. There's a variation of different people, but right now the data shows that people are performing. Now, as we mentioned earlier in this stream, FHA loans, VA loans are going to be the ones that are likely hit the hardest because, typically these, less down payment when they went into the property. So, equity might be an issue in some of these cases. But what we know last year alone is that home prices in most markets went up. I don't know. I mean, I can't venture to say 10% or so in a lot of markets out there. So home prices appreciated quite a bit last year. So I think a lot of people that went into forbearance are going to be in a position where if they can't get the option that they want, and what do I mean by option? So when you go into forbearance, you're essentially supposed to be given 4 different options if you had a federally backed loan, or Fannie Mae or what have you, or FHA or what have you. And so that those were a payment deferral. In FHA, that's a partial claim, which allows you to take that amount, add it to the back of the loan, and or some sort of repayment, a loan modification, or they might restructure your loan in some other way. And so there was a lot of people out there saying, hey, you should take forbearance even if you don't need it because you can just throw the money to the back of the loan. Not necessarily true. Not everyone is going to qualify for that. And what I'm hearing more and more now is that people that took forbearance and have applied for that deferral aren't getting it, for one reason or another. And one of those things that you have to meet, the guidelines, is that you have to be able to show that you're capable of making those payments, your monthly payment that you had before. You've got to be able to provide documentation that shows that you can continue making the payment that you had before. So are they requalifying you like they would a normal loan? We don't really know. It's kind of a black box. And so, I don't know exactly how all of that's going to unfold, but I do know that a lot of people have equity in their property. Savings last year amongst Americans was the highest level ever. I think it was like 1.2 trillion in the United States. So people have money, people have equity. So I don't think you're going to see this foreclosure wave, this big, supply hit the market at one time, which I think is what a lot of people are expecting to happen. But it's hard to say. I mean, it's, I honestly believe that these lenders, the government will probably work out something else if they start to see numbers higher than I don't, than they want to see. Josh, thoughts on any of that?
Yeah, let me throw this because at our conference call today, we're a little bit of a mastermind of some inside the mortgage industry folks talking about forbearance and what we can do to help people. So I'll be the first to say that my business partner, Scott, has taken the lead with our forbearance education efforts. Jeb has done a ton of this. So the two of them know the inside and outs of the guidelines better than I do. But what we can say is if you look back to the last downturn, the loss mitigation efforts were an absolute disaster. People were not treated well, they weren't treated fairly, and the outcomes weren't even good for the servicers, the people who were supposed to collect the payments and the people that made the loans. So that was largely where the CFPB came from, the reason why it was created. So under Trump for the last 4 years, the mortgage industry has not really been paid attention to, largely because everything was going well. Why upset the apple cart? Well, now we've got an issue. We have this pandemic. We have a lot of people who are needing solid loss mitigation responses from their lender, and that's where the forbearance stuff falls under. Most of them have done anywhere from an average to poor job. So, excuse me. When we look at how they've reacted, it's all over the place. What I can say with Biden in office, with his new nominee to head the CFPB, the mortgage industry is going to get looked at. And the first place to get looked at, because on the origination side, we're really regulated. It's hard to take advantage of a consumer. Where consumers are getting hassled, taken advantage of, troubled, is in the loss mitigation space. So I think we're going to see soon a lender or servicer get whacked really hard by the CFPB, and it will pull the other ones in line really quickly. So the guidelines are fairly straightforward with what they should do. They've unfolded and rolled out over a slow period of time, but I would expect borrowers to get treated much better than what they were 10, 12 years ago when the market went sideways, just because people can see what the government is capable of doing when they don't treat consumers. So, and the flip side of it, the outcomes for the owners of the loans were bad. They lost more money than they needed to because they did a poor job of keeping people in their homes. They would have been better off in most cases writing down big losses and keeping someone paying and in their home than taking back the home, selling it for even less into the market. So I think there have been some lessons learned, not nearly as much as we had hoped or should have been learned. So I'm hopeful for people in forbearance. What I can say anecdotally, although Scott and Jeb have really researched the guidelines, what I get to see is I talk to people every day, and a lot of people that are looking to refinance now took forbearance, and most of the ones that are looking to refinance didn't need to. Nearly every person that I've successfully closed a loan for after forbearance, they either asked for it because they got the advice on the internet, hey, just do it, there's no downside to it. And we had some headaches and hassles of getting them refinanced because of that. I have an example. I have a client who makes a large sum of money. A lot of that is in restricted stock options that vest once a year. So he did not ask for forbearance. His lender called and said, hey, would you like 90 days forbearance, not make your payments, no questions asked? And he goes, cool, I'll just pay it back when I check in with my restricted stock units at the end of the year. And for him, they never even asked him to pay it back. He didn't have to ask anything. They just put those 90 days payments. After 90 days, the payment started again, and they put them on the back of the loan. We just did the refinance for him here last month, and we're like, hey, what's this payoff demand? Why does it say a secondary mortgage balance? And he goes, oh, well, they offered me this. And we're like, all right, cool. We showed the guideline is you have to have made 3 on-time payments, and you have to have an agreement showing that you were coming out of forbearance. And that servicer was awesome. He called up and they go, yeah, we have that right here. 2 hours later, they faxed over the agreement. We showed he had made 3 on-time payments. We closed his refinance and paid off that back balance. That's like a best case scenario. It's like a dream. They call and offer you to take 3 months off of payment, just stick it on the back of the loan and give you all the documentation you need to be able to refinance. So long answer to a fairly simple and straightforward question, but that's my 2 cents.
No, and honestly, I think I do think the lenders are going to help more than they're appearing at the moment. I mean, there's a lot of people that comment and say they want to take your house and all. They don't want your property. It costs way more money to foreclose and on a property than it does to help someone else and help stay in that property, right? I mean, the lender continues to make money if they own that property, whereas if they foreclose on it, it's court cost, it's time, it's losing money. These banks want to make money, so it's not something that they want to get into. And plus, I think you'll probably see a lot of litigation this time around too, just because of the way this whole thing unfolded.
So you have the fear of God of litigation, and then you also have the desire for avoiding loss and helping borrowers. They lose less money than taking back people's homes.
No, 1,000%. And Turo Man 616, thanks for the super chat, much appreciated. All right, let's go up here, Josh. We're at an hour. Do you have some time, or you got to go?
I'm good. My wife might have my buffalo wings at home already, but fortunately they hold pretty well.
All right, we're going to answer a couple more here while we got people going here. I'm trying to find one, guys. Bear with me.
While you're looking, I just want to, Harpreet Sandhu has a question, and it's really specific. What I would say is we will put both of our contact info up at the end. I would love to answer that question for you. I don't think that most of the people watching want to hear us go through specific numbers because it's not super easy to just do in 2 seconds. But reach out. I'd be more than happy to run those numbers and give you a back of the napkin quick sort of pre-qual number of what you would qualify for. And it should be good with the numbers that you posted there.
Awesome. Georgina has a question here that, so loved your escalation clause video. Quick question. What do you think about buying houses with no or not finalized permits? Sometimes the advertised
square footage.
Oh yeah. Square foot is not the official square foot. So on and so forth. So it's, there's a lot of, I mean, honestly, like a lot of people do things without permits, whether it's, putting in an air conditioning, putting in a water heater, doing things like that. And a lot of those don't really matter in a lot of cases, at least in my opinion, right? I mean, I'm more open to the idea that people can do some of these things as long as they're done in a workmanlike manner. Permits aren't really that big of a deal. When people start removing walls, that were load bearing and that sort of thing, room additions, that is where I think you need permits. You need to make sure you're doing your due diligence to make sure things were done correctly, because those things can have a real big impact. I mean, if somebody put in an air conditioning or a bathroom remodel and they didn't, get permits, the likelihood of something big happening there is pretty minuscule. Whereas if somebody does, a room addition and or removes a wall. Right now, we're seeing a lot of people go into the open concept floor plans where, it's one big great room and people are removing walls. And I see people doing it all the time. I walk into properties and I'm looking up at the headers and I can tell that something's not right. And there's a second story above some of these and it's just not good. So I would tell you to, just make sure your agent has your best interest in mind. I mean, most counties, most cities have the ability to look at permits either online and or go down to the county and pull them up. So just figure out what it is that you're worried about and see if you can come to a conclusion. And sometimes these things are done in a workmanlike manner. Engineers used plans and did it all correctly. They just didn't get permits. And so sometimes if you can get a seller to provide you with that documentation to make you feel comfortable, then it's okay. But just, it's not really a straightforward answer. And I think each case is going to be a little bit different on that.
No, I would say absolutely. And most of the people here, all of the people here wouldn't know that when the market was in the tank and we were talking about people getting their homes foreclosed on and loss mitigation not going well, I primarily flipped homes. We were buying foreclosures and you would go in and you'd see all sorts of crazy stuff. Now, we knew we were going to fix them, but my bigger concern was not was it permitted or not, but was it done to code? So that's where a good home inspector comes in. A lot of home inspectors, they're just there for a $400 check to go through and check the boxes and give you a report. But a true professional home inspector that knows codes and can go through and say, hey, I would check to see if there's permits here, but if they're not, it looks to have been done to code. It looks like you could get it permitted if you wanted to. Those are the more important questions to me. I don't want anything unsafe around my house. I don't want anything that's going to be problematic.
I'm just throwing that contact information up there. Harpreet asks for info again. Hopefully you can get that there. So my name at myname.net, Jeb at Jeb Smith, and Josh at Bywise Mortgage. Let's answer a couple more questions and let these people enjoy their families and have a good night.
Throw her follow-up because it's actually a good one here. Basically asking, hey, cool, I find a house that appears to be done in a workmanlike manner but not permitted. Will it impact the lending or the appraisal?
Good.
It could. It most likely won't, but it could. An appraiser will make a comment. Does it appear to have been done in a workmanlike manner, and does it appear to meet code? They're not inspectors. They're not going to certify that, but that's generally what the lender is wanting to know. So I'm not going to say it won't cause you a problem, but most of the time it doesn't unless it's obviously not to code and problematic.
Got it. And some of those room additions, if it's a room addition and or whatever, sometimes the appraiser can't give it value in some cases, right? So if they're using, say, a room addition off the back of a house and let's say it's 400 square feet and they're calculating that square footage into the value of the property, and you're buying that property based on the value, the fact that that square footage is part of the home, that can be an issue because sometimes appraisers, I don't know how they're doing it these days, but typically what I remember is that, these appraisers are going in and saying, well, I can't really give that value. And so it may affect the actual appraisal at the end of the day. Is that still the case, Josh?
It can. And the reason why I say can is, let's say that you, like the situation you were saying, someone hires engineers, they get plans drawn, they hire an awesome contractor and they go, contractor, I don't want to pay for permits. Come throw this on the back of my house. Or they are a contractor and they do it themselves. I have a couple clients that are contractors. They've done some awesome work on their houses and it's not permitted. If an appraiser comes over there, other than saying square footage doesn't match, they don't necessarily see the permits being an issue. So it can trigger it. Most times it will, just when they see the match between taped square footage that they're measuring and what's on public records. But a lot of times when it's workmanlike, it will get through. And it comes down to the loan program. It also comes down to a lot of the other strengths of the borrower. A lot of times people want it to be a black and white answer, and it may even be black and white in the guidelines. That doesn't mean that we can't work around it or find a way to get things done when it makes sense.
No, awesome. Let's go one more question. I'm just going to post this up here. Steven's 100% disabled veteran. Just want to say thanks for your service there, Steven. Having a hard time in the Vegas market. Yeah, I mean, Vegas is a lot like everywhere at the moment, just not a lot of supply and high buyer demand. Fortunately, in Vegas, you have new construction, you have more developments coming up. So, maybe, people are asking these days, should I venture towards new construction versus, existing homes? And in some markets, that might be the way that you get into a market a little quicker, just because there's more supply in some of these markets with those, and you not have to compete as much on those. But here in Southern California and other markets, Seattle and some of these crazy markets, they just don't have the ability to build, so it's always going to be an issue. One more question, Josh. See something that jumps out?
Well, here, we can kind of jump on the back of that last question. Brandon Clark is saying, with low inventory and home prices going up so quickly, is it a good time to flip homes instead of just buying turnkey rental? So the problem that you will run into, it is a good market because home values are going up quickly. So if you make a good buy, you're likely to have it be going up while you're doing the construction to offset your holding costs. The problem is getting a good deal, because most people, even with a garbage home that needs $200,000 worth of work, they know values are really good. So what I tell people to be careful with in the current market is, and I'm sure you'll co-sign on this one, Jeb, in a bad market, a home that needs a bunch of work gets a really big discount. $100,000 worth of work is going to get you $150,000 or $200,000 discount, because someone can go find a nice home at a discount and just cruise in tomorrow and have it done. When the market gets hot, that discount is smaller than it needs to be. Maybe $100,000 to bring it up to the standards of the nice home in the neighborhood, but you get a $50,000 discount for it. And you're like, hey, I got a $50,000 discount. And I say, congratulations, you need $100,000 to get it to what it should have sold for. So I have clients and friends that flip houses, even in the current market. It takes big balls. They have bigger balls than I do. It's more speculative than in a down market, which is where I'm really comfortable flipping. But absolutely, it can be done. It's just a tough market for a newbie to step in when you don't really know everything cold. How much it's going to cost? How long's my hold time? Is this really a good buy?
And I'm going to add on to that, because this is something we've talked about a lot in different videos, but I think it's worth commenting here too, is that, a lot of people expect foreclosures to come to the market. They expect, more inventory to pick up, and that prices, you're going to be able to get a deal on foreclosures, for example. This kind of goes along with the same thing, right? Is that people are expecting these properties to come to the market, and they're expecting that they're going to be able to get a discount because they're a foreclosure or because they're a short sale or whatever the case is. Understand that, I understand, Brandon, I'm not talking to you directly here. I'm going to take you off just so you don't feel like I'm throwing
Stop
jabs,
lecturing me, Jeb.
throwing jabs at you. But understand that any property that comes to the market right now that seems like it's priced too good to be true or priced at a significant discount, chances are it's going to come close to the fair market value of that property, because there are so many people out there bidding and want opportunities not only to flip property, but to get in and make it their own and watch HGTV and, do a husband and wife remodel, and it's going to be great. So the idea that, that the inventory is going to change because you got these foreclosures coming and that you're going to be able to get some good deal, I think is pie in the sky. Just understand, if that happens, as those properties come in, your competition is going to be those investors that have cash, that have the ability to, put it out there and make deals happen quick. And so, just keep that in mind as buyers. If you're sitting on the sidelines thinking that that's going to be your opportunity to get in the market, I don't think that's going to be the case. But I will end on that note. Josh, any parting words there?
No, again, everyone thinks that there is something inherent in a short sale or a foreclosure that makes it sell for less or makes it come at a discount. There is absolutely not. When we have a heavy distressed market like 2008, 2009, 2010, 11, 12, then we absolutely, he's making fun of you. When you have that type of heavily distressed market, everything's selling at a discount. It's not because those are short sales and foreclosures. It's because there are more buyers than sellers. So the buyers can look around and pick and make 5 offers and go, who will take my lowest offer? So the best example that I can give, in 2008, late 2008, we bought our first foreclosure, and we got a great price on it. All the way through 2009, we were making offers on bank-owned properties, and we were often the only offer. So the bank's choice was, do we take their offer or do we want to own this longer? So that's why we were getting discounts, not because it was a foreclosure, because the bank had no one else to sell to. By 2010, everyone had figured out, hey, there's people buying houses at discounts and making money. Now there's 6, 7, 8 offers. So they were getting closer to a fair market value. But again, there weren't so many buyers who could pay cash for distressed properties. They were selling for discounts at that point. You, as a standard home buyer, most likely cannot pay cash for a home and are not willing to go to a hard money lender and put 30 or 40% down. So those aren't even an option for you. They sell at a discount because you can't get traditional financing. Any home that qualifies for traditional financing and comes into a market with supply-demand imbalance in favor of sellers is going to sell at a premium, just like every other house on the market.
Absolutely. And even back in the days when there was that imbalance, like towards the end of that foreclosure era, and when REOs, rather, like 2011, beginning of 2012. Now the market started to shift during that point, but at that time, the foreclosures I was selling were selling pretty close to what the other homes in the neighborhood were selling for. Now it's because the banks got smart at the end and started doing some of the rehab themselves versus just coming in with a complete dump and putting it on the market, because they realized that if they put a little bit of money into it, they could get it back out. And so the banks got smarter towards the end. And so who knows how it's going to play out, and if it plays out and when it plays out and all that good stuff in the future. But just know that, there's a lot of cash sitting on the sidelines. A lot.
Well, again, we have the government sticking their fingers in here and not letting free market forces take effect, because what they said, they were mad at the end of the last downturn that you had institutional investors that would come in and go to Fannie Mae or go to an investor that had a block of 100 foreclosures and just buy them all at a discount. Now, that was in the seller's best interest, because rather than taking all the time to sell them, paying realtors, paying fix-up fees, they would rather take a discount and just dump all 100 of them onto the investor, who would fix them up and either rent them or put them into the market. Well, now in California, you're not allowed to do that. You have to take it to the market and sell them one at a time, or at least attempt to, before you're allowed to sell them in bulk. So who knows? Every market is different. We can't look back and say 2008, 2009 was this way, and the next foreclosure market's going to look like that. The next one will be different than the last one, and we have a different set of guidelines and a different experience from the holders, the servicers, and the owners of those loans. So it will be different than the last one.
But when will it happen?
Who knows? It's not going to be soon.
That's what everyone wants to know.
The answer is not soon. So if your time horizon is 3 or less years, we're not going to see a downturn. We could, again, bore you with the details and the actual math behind it, but it's not happening.
All right. That's all we got, man. So join us next week. on another live Wednesday. No, I'll be doing this again next week, 6 o'clock. Would love to have you guys join in and, ask your questions. I'm sure we'll have Josh back here again, unless we can find a better looking guest.
That wouldn't be hard. That part wouldn't be hard. And hey, the thing that I would say, hey, when we throw these emails up here, now granted, we're not a nonprofit sitting here just answering questions all day, but we do answer a lot of questions. And if you have important questions and you don't have anywhere to get them answered, shoot them over to us. We'll get you an answer. We can't help in most states. We're not local to you, but we can connect you with someone that can. But don't feel like you can't ask a question. This afternoon, I talked to someone that Jeb had referred over that came through. It was either a live or one of his videos, and the guy was like, well, I'm not ready to buy. I don't want to waste your time. Well, you're going to buy at some point, right? That's your goal. So why don't we talk and put a game plan together now, so when the time comes, you're ready. And if there's anything you need to work on between now and then, you can do that. So don't feel like you're a nuisance. We're here because we like to help. And for some reason, this is the only thing the two of us know is real estate and finance.
Yeah. If you want to know about anything else,
you're out of luck.
Yeah, we're not your people. But if you haven't done so already, you're still watching, hit the subscribe button, like this, let more people see it. I will be pulling this down in about 48 hours, putting it into membership only. So if you're not a member and you want to continue to watch this sort of thing, I believe it's $5 a month if you're interested. So thank you guys for watching. We'll be here next week. Talk soon. Have a great night. Bye-bye.